Hello and welcome to AI Market News by LM. Before we jump into the deep dive, we just need to cover this mandatory disclaimer. This video's audio is automatically generated by NotebookLM, an AI-powered tool. The reference sources used in the summary are listed in the video description. As this content is AI-generated, there may be errors in proper names, pronunciation, or unnatural speech. This video does not provide investment or trading advice. Please make investment decisions at your own discretion. All right, let's dig into the stack of sources we have for Monday, September 22, 2025. Our mission today really is a deep dive into global markets. We're focusing on this pretty astonishing divergence we're seeing. U.S. equity euphoria seems to be running headlong into some serious geopolitical and policy risks. So we're tracking major currency pairs, equity leaders, and those crucial central bank shifts we need to understand right now.
Yeah, it's definitely an opening to the week that's defined by contrast. On one hand, you've got the S&P 500 near fresh record highs. That reflects, I think, a pervasive sense of comfort about U.S. monetary policy. But on the other hand, the underlying narratives, particularly in geopolitics and certain corners of the currency market, they're screaming instability. We really need to help sift through that noise.
Okay, let's start with that U.S. euphoria then. The source material confirms we closed last week near all-time records. The S&P 500, it finished Friday at 666.64.36, up almost 0.5%. The Dow Jones also added, 0.37%? It's quite a run.
It is. And what's driving this? Well, it's the sheer concentrated momentum of the U.S. tech sector. We've seen a massive, $15 trillion rally since those April lows. However, this is where the caution starts creeping in, because several high-profile commentaries in the sources are drawing these, uncomfortable comparisons to the 1999 tech bubble.
That comparison is probably the most interesting nugget here. What specific data are they using? Is it just excitement, or is there a genuine valuation worry?
It's largely about concentration risk and valuation metrics. The rally is almost exclusively driven by just a handful of mega-cap tech stocks. And when you see such overwhelming dominance, NASDAQ futures are already showing a bit of weakness this morning, down about 0.35%. It just raises questions about market breadth.
Right, and the fundamental support beyond those few key players.
Exactly.
Okay, moving over to Asia, that U.S. tech momentum certainly spilled over into Japan. The Nikkei hit a fresh record high today, up a solid 1.0%. Our sources point directly to positive reports around U.S. giants, specifically strong demand reports for Apple's upcoming iPhone 17 and large cloud contracts for Oracle.
But then look at the skepticism elsewhere.
Yeah.
We saw a pretty stark example in Hong Kong. BYD stock fell 3.4%. This was after reports that Warren Buffett's Berkshire Hathaway sold its entire stake in the Chinese EV maker.
Wow, the entire stake.
Yeah, investment they held for over 15 years. That isn't just a stock sale. It's a profound withdrawal of confidence from one of the market's most respected long-term holders.
That absolutely impacts investor psychology. Speaking of which, the Fear and Greed Index remains a critical gauge we track. It uses 7 indicators, including market momentum, how the S&P 500 stacks up against its 125-day average and stock price breadth. When markets are hitting records like this, we have to ask, does this represent fundamentally supported growth, or has the pendulum swung too far towards, excessive greed?
And if we look for immediate consequences of maybe that excessive greed, we find the crypto market. The start of this week saw a really violent flash crash. It suggests maybe many investors were over-leveraged.
Yeah, it was a sharp, sudden shakeup Monday morning. Over $1.5 billion in bullish positions were liquidated. Ether dropped by up to 9%, selling off to around $4,075, while Bitcoin fell roughly 3% to just under $112,000.
The sources seem to suggest this sudden pullback signals may be fading momentum, that momentum previously generated by these speculative digital asset treasury companies. The volatility just serves as a blunt reminder that even in high-risk assets, sentiment can turn really fast, especially when underlying market breadth is narrow.
Okay, let's pivot then to the macro drivers setting the global interest rate stage, starting with the Federal Reserve. The market seems strongly aligned now with the idea the Fed will cut rates further. The dot plot consensus implies 2 more cuts this year.
Absolutely. The baseline expectation now has the Fed funds target moving pretty aggressively towards 3% by the end of this cycle. And that expectation is providing the fuel and, frankly, the comfort for risk assets globally. To confirm this dovish narrative, we should definitely be listening closely to what FOMC members Williams and Barkin say in their speeches today and tomorrow.
Okay, contrast that dovish U.S. policy with the Bank of Japan. There, the entire narrative is about normalization and, tightening. Last week's BOJ meeting signaled a major step in that direction, albeit a cautious one.
They're very cautious. The BOJ outlined a plan to start gradually selling its massive ETF holdings. But what's fascinating here is the time frame. This plan is so gradual it could take over 100 years to complete.
100 years.
Yeah. This is a critical distinction. The sources emphasize it's really a political signal designed to minimize any short-term market liquidity crisis. It allows long-term pricing to shift without panic.
But if the action is designed to be almost negligible short-term, why are we seeing immediate market volatility? The prospect of normalization itself is already fueling higher JGB yields. The 2-year, 5-year, 10-year yields all hitting highs not seen since 2008.
Because the signal is what matters most right now, and that signal is creating this extreme divergence in yen positioning. USD/JPY is trading around 147.85, 148.06, but the internal battle among institutional investors is intense.
Talk us through that divergence. We have hedge funds heavily net short, betting on more weakness, while asset managers are substantially net long, betting on strengthening. Who's making the riskier bet here?
Well, the hedge funds are sitting on about 58,800 net short contracts. The asset managers hold over 71,000 net long contracts. This split, this gap between quick-moving short-term bets and these long-term allocations, it's approaching levels of divergence we haven't seen since 2007 and 2012.
That sounds like extreme uncertainty.
It absolutely signals extreme uncertainty. If the BOJ is forced to tighten faster than their 100-year timeline, those hedge funds will get squeezed violently. But if the Fed disappoints on rate cuts, then the asset managers face massive pressure. It's a real standoff.
Okay, shifting to Europe. The euro is holding strength, Euro USD around 1.1775. But the map of fiscal worry in the Eurozone is being completely redrawn. France is now the new epicenter of concern.
That's the major takeaway from the sources this week, yeah. France has basically replaced Italy as the focus of anxiety. This follows a second sovereign debt downgrade in just a week. France is struggling to credibly meet that EU 3% GDP deficit rule.
And the irony here is that Italy is suddenly the fiscal darling.
Exactly. Italy received an upgrade from Fitch Ratings. They've accelerated their deficit reduction pace and are now forecast to hit that 3% target as early as next year. It's a massive reversal in market perception, especially when you contrast it with the lack of a clear fiscal repair roadmap currently plaguing France.
That pervasive optimism around dovish monetary policy is also clearly visible in precious metals, right? Gold hit a new record high, $3,757.72 per ounce. Silver reached a 9-year high.
Yeah, when the cost of holding cash is expected to drop because everyone anticipates U.S. monetary easing, these non-yielding assets like gold and silver naturally become much more attractive hedges. This rally is underpinned entirely by the assumption that the Fed will deliver those cuts.
Okay, let's talk geopolitics. Rarely takes a break. We have some measurable progress on U.S.-China relations this week. President Trump and President Xi Jinping are scheduled to meet on the sidelines of the APEC summit in South Korea next month.
And the most actionable news there relates to that contentious TikTok deal. It seems to be nearing finalization, with a new deadline of December 16th. Our sources give some key details on the structure, which is designed to satisfy those national security concerns. Oracle will secure the U.S. TikTok algorithm, manage U.S. user data in a secure cloud, crucially ensuring absolutely no access by China.
And the governance structure puts American investors firmly in control.
That's right. Oracle, Andreessen Horowitz, Silver Lake, among others, they'll hold a majority of the board seats, 6 out of 7. And the ByteDance appointed member is excluded from the Security Committee. This looks like a major diplomatic breakthrough that could provide some market certainty.
Okay, moving from maybe foreign policy success to a domestic policy with global implications, the Trump administration is implementing a new $100,000 application fee for new H-1B visas.
Yeah, this is explicitly aimed at curbing alleged program abuses.
The White House did clarify renewals and current visa holders are unaffected, but the immediate market impact. It does raise concerns about corporate planning disruption.
Definitely. The sources highlight the risk of brain drain. This enormous fee significantly complicates hiring, particularly for U.S. tech companies that rely so heavily on highly skilled foreign talent. And given that Indian citizens represent about 70% of H-1B holders, this decision sends ripple effects straight through the corporate planning departments of major firms in India, too.
Okay, shifting back to Europe, we're seeing escalating geopolitical tensions in the Baltic region. That's always a major security flashpoint. Russia has violated Estonian airspace 3 times this month.
3 times, yes. And Estonia responded by formally invoking NATO Article 4. That's a big deal. It means they're calling for emergency consultations among all NATO allies because they feel their territorial integrity and security are being threatened. This directly led to an emergency UN Security Council meeting scheduled for today, Monday, September 22nd, U.S. time.
And the U.S. response remains ambiguous. President Trump hasn't commented publicly on the specific U.S. response to these Estonian incursions.
Not yet, no. And markets hate ambiguity, especially when NATO's involved.
Finally, on the diplomatic front, we see this coordinated global move regarding Palestine adding another layer of complexity. The UK, Canada, and Australia formally recognized a Palestinian state ahead of the UN General Assembly this week. France is expected to follow suit.
That's the expectation, yes. This coordinated move seems aimed at pressuring parties toward a two-state solution. But it drew immediate and sharp criticism from both the U.S. and Israel. They argue it rewards actions that threaten Israel's security.
It just highlights how unstable the wider geopolitical backdrop remains, doesn't it? Even with some positive news on U.S.-China trade.
It really does.
Okay, let's wrap up by looking at the week ahead, focusing on the upcoming economic calendar using data from investing.com to highlight what will really test these market narratives.
Right. We've already seen the Chicago Fed National Activity Index for August this morning came in slightly negative at mid-0.19 actual. But all eyes today are really on the central bank dialogue.
Yeah, as we mentioned, FOMC member Williams speaks at 9:45 a.m. ET, and then FOMC member Barkin speaks at 12:00 p.m. ET. We really need them to confirm that dovish consensus or risk undermining this whole equity rally.
Absolutely. And the key U.S. data release later this week will be the core PCE price index. This is the Fed's preferred measure of underlying inflation. A hotter-than-expected reading would immediately challenge the current expectation of 2 more rate cuts this year.
And for Europe,
Flash PMI data tomorrow, Tuesday. That'll provide fresh, critical insights into the health of the European economy, especially given those new fiscal uncertainties around France and Italy we talked about.
that data will be a key determinant for the euro's direction, I imagine.
For sure.
Okay, that completes our deep dive into the key market drivers for Monday, September 22nd. We're riding this wave of massive concentrated U.S. equity highs, but the underlying structure feels a bit shaky, highlighted by that crypto crash and those historical comparisons to the 1999 tech bubble.
And this market faces profound policy divergence. You've got the Fed signaling cuts while the BOJ finally moves, however slowly, toward tightening. That's creating extreme volatility in currency pairs like USD/JPY. Plus, geopolitical risks, from H-1B policy disruption to escalating NATO tensions, they remain paramount.
So here's our final thought for everyone to mull over. Given the speed and coordination of these diplomatic moves regarding Palestine recognition, does our source material suggest that global commodity markets, particularly oil, are now maybe forced to price in a level of Middle East instability that even a dovish Federal Reserve can't entirely offset? Keep that question in mind as we track the volatility this week. Thanks for watching. Don't forget to like and subscribe.